Good evening and welcome to Night Markets. Each week I'll be giving you my perspective on what's been driving markets as well as my point of view as a family office professional. My name is Jacobus Brink, the Chief Investment Officer and Head of Investment Research for South Africa at SFO. The week also witnessed some indications of a market rotation and broadening breadth, with value equities outperforming growth shares and the majority of the major benchmarks outperforming the tech-heavy Nasdaq. Friday was a day known as the triple witching event, as approximately $5.5 trillion in options related to individual equities, indices, and exchange-traded funds were all scheduled to expire on the same day. These events tend to lead to some higher volumes as well as increased volatility. So before we move on to markets, let's just have a check-in on the current situation in the Middle East. Over the weekend, in what seems to be a broadening conflict, Israeli attacks on Gaza City's northern district resulted in the deaths of at least 42 individuals, and Hezbollah combatants were the targets of Israeli military attacks on Saturday evening. There were reports that Israeli warplanes struck a Hezbollah observation post in the southern regions of Lebanon, and the big risk here is that this could actually escalate into a larger conflict within the Middle Eastern region. And after months of increasing cross-border assaults in southern Lebanon and in northern Israel, tensions between Israel and Hezbollah continue to be on the rise. This definitely doesn't bode well for the outlook in the Middle East and particularly the impact it could have on oil markets. Then starting off with markets in the Americas, the market saw some additional evidence at the beginning of the week that suggests consumers may be becoming a little more cautious due to dwindling savings and alleviating labor demand. The Commerce Department reported on Tuesday that retail sales had increased by only 0.1% in May. In April, that declined by a downwardly revised 0.2%. But it was interesting to note that sales at bars and restaurants specifically decreased by 0.4%, which could possibly suggest that a decrease in discretionary spending is actually starting to take hold. Sales at grocery stores also decreased by 0.4%, which may be indicative of recent price reductions in specific food categories. The manufacturing numbers that were released on the same day were somewhat more robust, which was a departure from recent trends. In May, the Federal Reserve reported that industrial production had actually increased by 0.9%, which was significantly higher than the consensus estimate, and the quickest rate in nearly a year. In addition, factories were operating at almost 80% of their capacity, which was slightly higher than anticipated and the highest level we'd seen since November of last year. Data out later in the week also arguably suggested that the economy was stronger than the retail sales data initially released indicated. According to preliminary data released on Friday, S&P Global reported that its composite index of business activity had increased to 54.6 in June, the highest level in more than 2 years. The big issue, however, was that payrolls also increased at the fastest rate in 5 months, and the service sector appeared to be in a very good health, rebounding from 2 months of decline. The sector's selling price pressures were among the lowest recorded since the onset of the pandemic, which is a source of encouragement. Nevertheless, wage expenses for service providers remained elevated, indicating that there was some downward pressure on operating margins. The lackluster retail sales data we saw earlier in the week pushed longer-term treasury yields lower, but Friday's stronger S&P Global readings brought them back up to end the week modestly higher at 4.26%. On the equity side, another week of divergent outcomes. The S&P 500 index ended the week higher by 0.38%, while the Nasdaq rallied to end the week 0.73% higher. The Dow Jones Industrial Average was, however, the outperformer for the week, ending up by 1.15%, as we saw a much more broad-based rally from the overall market. Then moving across to the Eurozone and the UK, in June, Eurozone's private sector business activity experienced an unexpected decline due to the severe contraction of manufacturing and the loss of momentum in services, as indicated by the purchasing manager surveys. According to provisional figures compiled by S&P Global, the Composite Purchasing Managers Index, which encompasses manufacturing and services activity, decreased from 52.2 in May to 50.8%. According to provisional figures provided by S&P Global, the Composite Purchasing Managers Index, which encompasses manufacturing and services activity, decreased from 52.2 in May to 50.8. This is still an expansionary territory, but it is a departure from the previous stronger reading that we did see. Germany was indicative of the weakness in manufacturing production as overall business activity increased marginally. Output contracted for the second consecutive month in France due to a decrease in new orders. And in what was the highlight on the UK economic calendar, the BOE maintained its primary interest rate at 5.25%, as anticipated. Interesting to see that 2 of the members of the Monetary Policy Committee supported a reduction to 5%, while 7 voted to maintain the rates at the current level. The decision was perceived as finely balanced by certain members, which could indicate that policymakers are actually inching closer to reducing borrowing costs this year. Also interestingly, in May, the UK headline inflation rate decreased to the central bank's objective of 2% for the first time since August 2021. However, core inflation, which excludes the more volatile food and energy components, decreased from 3.9% in April to 3.5%. Nevertheless, the consensus expectation of 5.7% inflation in the services sector was quite high. And then just looking at performances in local currency terms, the Pan-European Stocks Europe 600 index ended 0.79% higher. Most of this rebound was as worries about political uncertainty appeared to ebb and the outlook for monetary policy easing actually brightened. Okay, then moving further east, Japan's stock markets generated negative returns over the week, with the Nikkei 225 index falling 0.6% and the broader Topix index down 0.8%. This was mostly due to uncertainty about the future trajectory of the Bank of Japan's monetary policy, and this continued to weigh on sentiment. We also saw the yield on the 10-year Japanese government bond increase from 0.93% at the end of the previous week to 0.97%, as investors analyzed data indicating that inflation had increased in May, and how this could possibly influence the Bank of Japan's decision process regarding the timing of the next interest rate increase. And following a 2.2% increase in April, the nationwide core consumer price index increased by 2.5% over the year in May, slightly short of the consensus expectation of a 2.6% increase. So despite the inflation numbers falling slightly short of expectations, the governor of the Bank of Japan has reiterated that the rate hike in July is feasible, but it is contingent upon the availability of data. The yen also continued to depreciate against the US dollar. It fell all the way to 158.8 from the previous week's 157.4, and it's still hovering near that 34-year low as a result of the US-Japan interest rate differential. Japanese authorities also once again indicated their willingness to take decisive action in the event of excessive circulation and volatility in the currency market. On the macroeconomic front, composite PMI numbers decreased from 52.6 in May to 50 in June, indicating a slight halt in the expansion of business activity in Japan's private sector. This was partially due to labor constraints, which were the cause of a decrease in services activity. Nevertheless, the manufacturing sector did experience a slight improvement in business conditions for the second consecutive month. The yen's continued weakness and robust increases in shipments to the US and China in particular contributed to a 13.5% year-over-year increase in Japan's exports in May. Then moving across to Chinese markets, Chinese stocks retreated once again as mixed economic data dampened investor sentiment. In May, industrial production increased by a weaker than anticipated 5.6% from the previous year, quite a large decrease from the 6.7% increase we saw in April. In May, retail sales also registered a 3.7% increase from the previous year, surpassing the 2.3% increase in April. On the monetary policy front, the People's Bank of China injected some more liquidity into the banking system through its medium-term lending facility. However, we did actually see a net outflow due to some expiring loans. And we haven't seen any respite on the struggling property front yet. China's new property prices experienced a 0.7% decline in May, which was the most significant month-over-month decline in nearly a decade, following a decline of 0.6% in April. This data revealed that new home prices had now declined for the 11th consecutive month, despite a lot of liquidity being injected into the market. And then locally, South Africans had a lot to smile about this week as we saw some positive sentiment returning to the market post the election results. After being sworn in for another term, South African President Cyril Ramaphosa initiated discussions regarding the appointment of the new cabinet. However, the ANC and the DA have been at odds this week regarding the interpretation of a framework that was signed the previous week that will actually govern the alliance. The ANC maintains that the agreement cannot supersede the constitution, which grants the president the authority to appoint the cabinet, despite the DA's assertion that the accord provides for representation in the cabinet that is proportional to its performance in the election held last month. In macroeconomic news, consumer prices rose by 5.2% on an annual basis last month, and this was unchanged from April. It was also in line with the median forecasts of economists, and the market is increasingly wagering that South African inflation will start to slow down to the midpoint of the central bank's targeted range at 4.5%. This will obviously provide policymakers the flexibility to transition to an interest rate cutting cycle by the final quarter of this year. It is anticipated that the South African Reserve Bank will implement a 50 basis point reduction this year, followed by an additional 50 basis point reduction in the subsequent year. In response to improved risk sentiment as well as declining inflation data, South African assets in general had a very strong week. The JSE All-Share Index ended the week higher at 3.52% after hitting an all-time high during the week. With most sectors ending higher, the financial sector actually experienced the largest gains, ending higher by more than 6% during the week. The Rand also managed to end the week below the very psychological 18 Rand level to the US dollar for the first time in almost a year, as bond yields also dropped precipitously during the week. And then just looking at the week ahead, during the week, markets may see some renewed volatility on the back of some notable US economic data releases. Earlier in the week, we'll see some consumer confidence data as well as durable goods orders out of the US, which could all actually be potential market movers. But the highlight will definitely be Wednesday's final US first quarter GDP report and Friday's US core PCE release, which will be the focus for the week. We'll also see some inflation numbers out of the EU towards the end of the week, which will also be of interest to the market. On the local front, the market will continue to focus on the discussions between political parties with regards to the Constitution of Parliament, as well as some PPI numbers on Thursday. And we'll also see the release of the SARB's quarterly bulletin, which could give the market an indication of which way the committee might be leaning with regards to interest rates. And then, as always, we'd like to end off with an interesting investment conversation we've been having during the week. This week, with the general positive sentiment around, we've been focusing a lot on the SA Inc. story. Despite the market not having really sold off a lot during the last number of months and also hitting an all-time high, SA Inc. shares in particular have borne the brunt of most of the negative risk sentiment around the country. We think these shares, despite rallying quite strongly during the week, could still see a lot of upside going forward should this positive sentiment continue. The Rand will be the main indicator to keep an eye on, as any negative sentiment could actually see us breach that 18 Rand to the dollar level again. Further to this, what would be interesting is to see whether the Rand can actually continue trading below that 18 Rand level. If it can actually sustain this, we could possibly see it moving down all the way to 17 Rand to the US dollar. Thank you for joining me this evening on another episode of Night Markets. Financial markets close at 5 p.m. Night markets open at 6 p.m. Let's start the conversation.